Before we start today's show, I just wanted to mention our sponsor, Wealthify. Wealthify is regulated by the FCA and is a multi-award winning online and app-based investment service founded in 2016 and owned by Aviva, with a simple mission to make investing accessible to everyone. You can invest from as little as £1, and Wealthify offers a number of investment products, including a stocks and shares ISA, a general investment account, and a personal pension. However, Wealthify also offers a junior ISA, which allows parents to save for their child's future through investing. Wealthify also offers ethical junior ISAs and the ability for family and friends to pay directly into its junior ISA account for the child's benefit. In the run-up to Christmas, this could provide a meaningful and eco-friendly alternative to present buying. With investing, your capital is at risk and you could get back less than you put in. For more information, head over to moneytothemasses.com and search Wealthify. Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, it's great when you highlight something in the show and it proves to be quite prophetic. Following the market jitters surrounding Omicron and a US Federal Reserve seemingly set on tapering its quantitative easing program even faster, despite the arrival of that new COVID variant, I highlighted last time that the market was primed for a potential rebound. Now, I explained how certain momentum indicators suggested that equity markets were oversold and how history suggested that we were due that rebound. And I explained this in detail to 80/20 investor subscribers last week in a bespoke piece of research, but I also discussed how the relative strength index, which is called the RSI, can be used to identify potential market turning points. Now, having identified such a point, the market did indeed stage a rebound. Now, we can look for a catalyst for why the rebound occurred right at that point. Perhaps it was the more favorable news on the danger posed by Omicron, or hope that the global central banks may be forced to rethink their plans to tighten monetary policy. That is, to rethink raising interest rates and or tapering quantitative easing. Also, Chinese authorities moved to manage the decline of ailing property developer Evergrande, which I've talked about previously on this show, and also to support the housing market. Now, all of this did obviously cheer global investors, and the net result is that we've seen an incredible 3-day rally on equity markets from the lows that we had last week. Now, the biggest winners were understandably the biggest losers in recent weeks. So if we look at the Nasdaq 100, for example, it has rallied more than 4%. And as has the German DAX, because the German DAX is quite growth orientated and that had taken a bit of a blow in recent weeks. Now, the S&P 500 is up 3.27% in the last 3 days. The FTSE 100 is up 3.05% and the Dow Jones is up 2.91%. And it also had one of its best days this year. Now, the MSCI All Countries World Index, which is obviously a broad measure of equity markets around the world, is up 2.89% from the lows of last week. And even Asian and emerging market equities have rallied, but typically they are up about, less than 1%. Now, ironically, so strong has the rally been in the last few days that some markets are now creeping towards overbought territory, having been oversold last week, but they're not quite there yet, so it's not panic stations. But many indices are either fast approaching or almost at their recent or all-time highs, and by that I mean they're less than 1% below those highs in many cases, and that includes the tech-heavy Nasdaq 100, which has been, it's had a tough time of late, as you might have noticed within your own portfolio, but the rebound has brought a bit of a swagger back to tech stocks. And in the coming days, it'll be interesting to see whether global equity market indices can push above their November highs. If they can, from a technical perspective, that is very positive and bullish. Now, UK investors have also been given a bit of a boost by the weakening pound. The pound has fallen to a 2021 low over concerns of new COVID measures being introduced in the UK. Now, the UK pound is at $1.32 and has also slumped against the euro. And in fact, the pound was already under pressure before there were concerns about those extra COVID measures possibly coming in, because one of the Bank of England's more hawkish members of the Monetary Policy Committee, and remember that's the committee that actually sets the Bank of England base rate, had already suggested that there were advantages of waiting before raising interest rates following the emergence of Omicron. Now, next week will answer a lot of questions for investment markets as the Fed and the Bank of England will announce their latest monetary policy decisions. Now, it had been expected that the Bank of England would raise interest rates next week, but now, as I've just mentioned, that is less certain, and both meetings do still have the potential to be market moving. And by that, I mean, depending on the decision, we could see some quite violent moves in equity markets. Now, we are also likely to find out in the next days and weeks more about the dangers of Omicron and whether new restrictions will be applied in the UK or elsewhere. That is why in the UK in the last 24 hours, while we've seen a little bit of hesitation on the FTSE 250 because it's much more domestically focused. So we'll probably find out more about what could happen to UK equities in the next week as well. So this is one of the reasons that bond yields have remained subdued. The 10-year US Treasury yield, for example, is hovering about 1.5%. So the market is still a little bit concerned about the potential impact of Omicron and any measures that could be introduced. But the stage does seem to be set for an end-of-year Santa rally, but there are those uncertainties out there, and they also include geopolitical tensions after the US warned Russia that new sanctions could be imposed, as well as support provided for the Ukraine military if Russia invades Ukraine. So perhaps the volatility of the last couple of weeks should be seen as a dress rehearsal of what to expect as we approach 2022. But for now, the market is back in risk-on mode, and bearing in mind the seasonal tailwind, it is starting to feel a lot like Christmas. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email. Damien@moneytothemasses.com is the email address. Twitter, money to the masses with the number 2. We're on TikTok, Instagram, and of course we are on Facebook. But don't forget to subscribe to our YouTube channel.